It's on the lips of every investor. A recession is coming, and it's time to sell. Or is it? Let's take a closer look at the implications of a possible recession and what this means for the markets and investors. Welcome to another episode of Money Matters. Many experts and laymen alike fear a recession is coming to the US. It's all over the headlines. Many already agree that it is likely to happen. Even the much hailed 2 to 10 year yield curve inverted back in March, which historically has been a reliable indicator of a following recession. Let's assume for the moment that a recession will occur in the US. Let's assume that it is almost a certainty. In which case, we should all sell our stocks and go hide in a bunker. Here's my first point. Markets are forward-looking, usually 3 to 12 months, sometimes longer. Why? Simple really. Investors, meaning markets and all their participants, are buying or selling based on what they think will happen in the future. The further we go, the murkier the forecast gets, and so it's usually short-term. Furthermore, many market participants are making short-term trades. Think of the investment bankers, traders, and other professionals. Market participants make judgment on what the future may look like. Therefore, if everyone is talking about recession, then the market prices will reflect this. The level at which it reflects this is dependent on the consensus that this will occur and how bad the recession will be. So, coming back to our scenario where it's a certainty that a recession will occur, then the market prices will have already fallen significantly to reflect this. Or to put it another way, it's too late to sell. Market prices will change depending on how the future reality compares with current expectations. i.e., if the recession is worse than we thought, then prices will correct downwards. But if the recession is milder than we thought, then the prices will correct upwards. Remember, current expectations versus future reality, and not current reality versus future reality. Here's my second point, and related to the first, market performance is not correlated to recessions. We can see here over the past 13 recessions that the S&P 500 index has no discernible correlation to the recession years. And note that in the following year, it often showed great positive returns. This comes back to my point that markets are forward-looking, about 1 year, to what a post-recession economic environment will look like. In about half of the cases here, the S&P 500 index was already rebounding in the same year of the recession, and over 3/4 of cases, the following year was a gain, and a significant one at that. My third point, let's say you do sell at the first whispers of a recession, and you manage to sell near the top of the market, or at least as it begins to fall. You now enjoy a period of holding cash whilst watching the market fall. When do you buy back? Market downturns are often followed with a strong rebound. It's like a depressed spring, in that the more it depresses, the stronger the bounce back. If you miss it, then you miss out on the gains as you're still holding onto cash. When the rebound is not strong and V-shaped, the point of rebound is not clear and hard to determine in the heat of the moment. Timing in and out of the market is easier said than done, and is an extremely high-risk strategy and may end up causing more harm than good. You have been warned. Hindsight is obviously a luxury we don't have, and in my years of managing wealth, I've never come across anyone, professional or amateur, who has successfully and consistently timed in and out of the market. It is far more prudent to ride out the recession than be tempted by the grandeur of thinking you can mitigate market losses during a bad bear and yet ride the gains during a bull. Instead, buy more after the markets have fallen heavily and benefit from buying when prices are cheap. Who doesn't love a sale? And stock markets are no different, which is why the old axiom remains: money makes money. So let's debunk the myth that we should sell in a recession. Get too jittery and you may end up worse off than before. Consider riding it out and consider buying more at the low prices. I wish you happy shopping if and when this recession occurs. Thank you for joining me on this episode. Let me know what other topics you would like to hear about in future videos. If you like the video, smash the like button, subscribe, and I'll see you in the next episode of Money Matters.